Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. We're going to hit up Twitter. We're also going to hit up TradingView, look at some charts together, give you my financial opinions. Obviously, we're going to talk about wealth or wealth building, financial topics, and or commodity type topics from Twitter. Commodities, in my opinion, are where it's at. That's the best risk reward. Very big asymmetric bets over in commodities. We have undersupply, and credit is growing. It was growing very rapidly. It's slowing down a little bit now. But the big overall, big picture view, decade long view, commodities are going to be the spot to be, in my opinion. If you need any help with anything, check out finding-value.com. Join our community. We do have a 5 p.m. Mountain Standard Time question and answer session coming up this Sunday. Let's dive in. Let's see what people are talking about, and I'm going to share my opinions across the board here. So, this guy says, buy assets and act broke. Well, that's exactly what I do. For the most part, I buy a lot of assets, and I don't act broke. I just don't buy things that make me look rich. Or make me look well off, or make me look upper middle class, or whatever the heck I guess I identify as. You like that, right, guys? So I buy assets, and I just don't find pleasure in buying things that are very expensive. I'm a guy where I live where the price and value go up, and they start to basically asymptotically approach some level. So I don't keep going out on the price curve if I don't have to. I'm a 100% value guy in everything I do. Want a sports car? Well, what's the best value sports car? What are the ones that look the best at the time? If I want windows on a house, well, what's the best value? I don't want to buy the most expensive ones if they don't provide enough value difference from something that might be mid-grade or upper mid-grade. And I can save a large chunk of money if I don't have to spend it. That type of stuff. So yeah, I agree with this, and this is basically what a lot of rich people do. They buy assets and they don't really spend it. And that's how they get rich. You get an accumulation of assets. It seems obvious to me, but I think a lot of people don't view it as that obvious. And I know a lot of people say, well, how do you do it? What is the special sauce? Let's go. We'll get into some stuff, guys, and I'll show you what the special sauce is, at least what my opinion is. It's a couple of things that you have to mix together. It's an ingredient. It's not one thing or another. I could sit here and tell everyone this is the best stock to buy. And it could be the best stock over the next decade. It could go up 30, 40 times. But you know what? The majority of people couldn't hold long enough. They don't have the willpower. They're not able to withstand 50% drawbacks or drawdowns. They get bored when the thing doesn't move at all in a 6-month period or 3-month period. It becomes a battle with yourself. So buy assets, act broke, and be disinterested in the assets that you own for a long period of time. You have to be indifferent. Indifferent meaning you can't really get too excited. You can't really get too down. It's like, this is cheap. I'm going to continue to buy it until it's not cheap. And it may take a couple years for that to rotate. That is how you make money. All these guys that are billionaires, they didn't make it overnight. They made it during a good, long stretch of market conditions that were favorable for their companies. And they did it for decades. Amazon was not a success overnight. Neither was Nvidia. Neither is Warren Buffett. Neither is Peter Lynch. Neither is any of these guys. They did it over long periods of time. And everyone else thinks that they can accelerate that get-rich-quick thing. Let me tell you, it's very hard to do that. To get very wealthy in a very short period of time, you're going to have to most likely be a Mark Zuckerberg type, where you open up a business or open up an idea and everybody adopts it very quickly. And yes, we are trying to identify companies that are like that. but they are generally much riskier than a company that is somewhat established that just continues to grind out good returns, like a Visa, a MasterCard, and some of these oil companies, I think, will do the same thing. TLT, big move off this double bottom today with the MACD curling up. So this is TLT, the bond market. And what we're having is a double bottom, perhaps. We're getting a good bounce here. One thing that I'm using this for is a gauge. Are interest rates going to go down or up? This is bond prices. This is TLT bond prices. Prices going up means interest rates are going down. Now, we could be getting a bounce here. What does that mean? Why do I care about this? Why should you care about this? Well, this move lower, has been an increase in interest rates. It's been a selling of bonds. When that reverses, it's going to change the market conditions for some of our investments. It's going to put a large tailwind, if this goes higher, behind gold and silver. We can also see that the inversion of the yield curve, the way it's inverted, is favorable with a long runway ahead of us for precious metals to go much higher. The sentiment in precious metals is pretty crappy. It hasn't really moved anywhere for a little while. And that's generally the best time to start really loading into things, is when people are disinterested. You have to stand apart from the crowd. You cannot stand and blend in. You cannot be a part of the herd. You cannot just conform to what other people's opinions are. You want to be the oddball. You want to be the person left out of the groupthink. You need to buy it when people are disinterested in it, when no one's talking about it. It's getting these good companies, throwing them on a watch list, and then the things that are down, you're like, you know what? I'm going to nibble on here. I'm going to buy a little bit here. I'm going to keep buying this. Get a little bit of physical metal, throw it in the stack or the account, and then just wait and be patient. That is literally what investing is. The problem is, people, they like excitement. They like it when the ball falls on black and they've got some sort of money on the roulette table. They just like that exhilarating feeling, the emotional response. Negative emotions are felt more than positive emotions. That's why YouTube channels are so negative. They are pandering to your negative side, because you're more likely to click negative clickbait crap. It doesn't mean they're right. It doesn't mean they're wrong. They just want your views. They have a positive feedback loop when they see your views, that you get negative. They keep pumping negative things because they're getting a positive feedback loop from that. More views, more earnings, negative feedback. Let's get more negative. Negative, negative, negative. And then all of a sudden you've got people who are just, a crash is going to occur every single weekend. But either way, this looks like to me that we could be getting a double bottom. It could go higher here. That means that precious metals could really start to move here. And commodities, they're kind of indifferent to this. But it does look good for precious metals. This is what happens when people can't afford home prices. The bad lending would eventually come back. Anything to keep the housing bubble inflated. It's not about the housing bubble being inflated. It's about the banks making money. They don't make money when they don't loan. Same with the people that work at the banks. Their commissions are based off of loan volumes. So Zillow Loans announced its 1% down payment program to allow eligible home buyers to pay as little as 1% down on their next home purchase. Guys, it's all part of the cycle. We are going to see a blow off top, most likely, at some point in the housing market. Is it going to happen when interest rates are this high? I don't know. I doubt it. But if interest rates were to go back down, I bet you we're going to get a big move to the upside. If we have this type of loans out there too, and interest payments drop at the same time, it could be one heck of a mix. What I'll say. But there is a shortage of homes. That's why there's no inventory of them. And they're going to start putting out all these loans again, guys. I agree with that. Not agree that we have them, but I am in agreement that these things are going to be coming. Wow, that was quick. So South Central natural gas storage really coming down here. in terms of inventory levels in storage. So this is the 5-year average is blue line, and we're almost back to the 5-year average, which is interesting for nat gas. Grady says, constantly get the question on how to get out of the rat race. There's no magic solution. Hard work and having a strategy is key. Plus making huge lifestyle sacrifices. Max your income, being brutal in minimizing consumption and expenses, and focusing on the commodities bull. Yeah, go Grady, man. One thing I want to say too about a lot of this stuff, I'm just going to make some kind of obvious assessments. What a lot of commodities have done is they've basically broken out of these big basing patterns. This is from technical analysis. They've broken out. They usually do a retest at some point. And what are we doing? We're doing that retest. That is generally the best time to look at a stock is when it's doing that retest. And right now, in a bunch of different commodities, we are doing that retest. You can see it across the board on a big picture view. This is a double bottom. It breaks out, and then there's your retest. You want to buy here, but we're still not that far off the bottom here, guys. What happens next is that this is a bottoming pattern where this goes into a big uptrend move. So they all have it. Copper has it. Rare earth metals have it. And we are getting an over-exaggerated move to the downside. That's actually a good time to be looking at some of these. But there's your downward move, your double bottom, and then you're going to work your way up. And it's across the board. That is how you make money. You make money by identifying the technical chart patterns, identifying the market conditions, identifying what's cheap from a ratio perspective. You tie it all together, and then you have to be ultra patient because it may take some years or a decade to fully play out. Your 20s are a great time to work hard and sacrifice for your future unless you die at 30. Now, here's something I want to just make a comment on. I did save a lot of money in my 20s. I mean, a lot. I did save. Now, I'll just say this, guys. In your 20s, if you're a guy, you're just like pumped, dude. You are so pumped in your 20s. You can do so much with the energy that you've got that don't forget that. I'll just say don't forget that. I don't regret anything. I did a lot in my 20s. But your 20s, man, you can do so much in a day. You can work out, you can go help someone move, and then go party at the end of the day without really even being tired. It's like, oh my God, that's awesome. But that changes as you get older. It does. I would say late 30s, early 40s. Definitely a little bit harder than it was than your 20s. This red day in uranium was absolutely predictable. Question is, do we continue down for a little bit? It doesn't even matter to me, guys. Like you become somewhat numb. A lot of people, what they do is they ask a lot of questions. They care about the short-term market movements. And I think a better strategy is to not really care about the short-term market movements. What I do is I create a list of companies that I really like, and I watch them. I find where they're bouncing off of support, and I just add at the support levels. You just add a little bit, add a little bit, add a little bit. A lot of the times it works out really well. Sometimes it doesn't work out and it goes down for a little bit longer. And that happens. That's part of investing and that's part of the game. But if you're buying a good company with the market conditions, basically with the tailwinds behind it, you're still going to get pullbacks in that. It doesn't mean that you're going to time everything completely right. A lot of people will say, oh, well, you just need to be better at technical analysis. Oh, you just need to be this. Guys, I don't think that you can time the short term with a very, very, very high degree of accuracy. We try our best. That's all you can do. You get the right companies. That's a big portion of it. You position size appropriately, and then you cost average in to basically hedge yourself against a downside move because then you can buy more later. And that's how I do it. That's how the big guys and the big boys do it. Olivia says, I quit my 9 to 5 to day trade full time when I was 14. Since then, I went from making $5 a year to $50,000 a month. Here's the one thing I learned in the process. Lie about being successful and sell a mid ebook on supply and demand. Perfect, guys. That's all you got to do. I thought it was kind of funny, but probably quite true with the majority of people that are out there. Be careful who you listen to. They need to make their money from the thing that you want to learn from. So if you want to be a good investor, learn from people who make money from investing. Don't try to learn from someone who doesn't really make, they didn't really make their money from investing. They made their money by creating a business, collecting fees by selling financial products that may not correlate well with what you're looking for. But keep that in mind. I recall watching DML, NXE, and FCU all 2021, looking for an entry point on Thursday, August 26th through Monday 30th. That weekend, I decided that it wasn't right time to jump in as the markets look shaky. I missed out on this. I feel we are at the same point again right now in August of 2023, and he circles it here before the big launch. I think we are in a very good location. So if I were to yank up URNM, and I know we go over this during a lot of the daily updates, let's do URA with some big picture view. Your basing patterns here, you've broken out of the basing pattern already. And an ideal entry point is right in this area here. That is your retest. And what we did is we basically consolidated on top of this. And I have a fractal from another company that I was looking at from the last bull market of commodities. We are at like the initial stage of the launch. And some of these companies have already moved up. So this here is a breakout. Like it's good to go in my opinion. Does it mean that we can't have another one of these sideways moves? Obviously, we could have that. But overall, if I were to look at this chart, I would say, this is your bottoming pattern. This is your breakout of that bottoming pattern. This is the retest of it. You should have been buying at this retest level and then just sitting and waiting for this to go higher. You got to have the patience. You got to have the wherewithal of seeing these types of charts. Now, the chart isn't what makes this go up. It's the fundamentals. The chart is a reflection of the fundamentals of uranium. The charts are is a reflection of the commodities bull market that is coming. The herd is just behaving in a way that you should be able to see what is about to happen next. Now, you're not going to pinpoint it. You're not going to get this with pinpoint accuracy. You're just going to get rough swags at it and say, yeah, we've bottomed. Yeah, we're going to go up. I just don't know the timing, the exact timing. And yes, the overall pattern is the same exact as the company I've got up there, which is a natural gas company, which is the same as the last commodity bull market. And then you'd say, well, we got increasing interest rates. That's when commodity bull markets go up. I mean, it all aligns. So, that's what you need to focus on. What are the drivers of the commodities bull market? The drivers are inflation, higher interest rates, and then you could look at the technical chart patterns to say, yeah, it's agreeing with what we're seeing. You got to tie it all together. It's time to climb a wall of worry. Palladium futures now have the largest net speculative short position on record. Overall, precious metals look incredibly attractive after the surge in prices from oversold levels. Amidst the prevailing overwhelmingly negative sentiment, gold appears to be gearing up for a historical breakout from a triple top technical formation. Major capital allocators are only starting to realize that traditional 60-40 portfolios are no longer the optimal positioning for navigating today's inflationary regime. That's your money rotation here, guys. That's where the money's going to come from, and they got to figure that out. Now, this is Palladium futures contract pricing, super negative. What I'm going to say is I don't think Palladium is the best deal. If I were to look and find platinum, so here's platinum to Palladium here. There's your deal, guys. Platinum is the cheaper metal. And if Palladium goes up, I think platinum will go up. Everything's going to benefit platinum, in my opinion. They're going to do substitutions from Palladium to platinum because it was the cheaper metal. Now we're at 0.76. It's getting a lot more balanced in terms of pricing. But what I'll say is, in history, under certain market conditions, what I think is coming is a large revaluation of platinum to outperform palladium and all the other metals potentially. Does that mean that it's 100% in the bag? No, no, it doesn't mean that's 100% in the bag. What it means is that platinum's a cheap metal and I should have exposure to it. I think silver's a cheap metal and the charts look good there and I should have exposure to it. I'm not. It's not all or nothing. It's accumulate the cheap assets and just wait for them to become overvalued. And if someone says, "Well, that could take 10 years," okay, tell me something that can beat this return here. Tell me something that can beat this return up, and then if you swapped to palladium up here, and then ride it all the way back down, there is nothing that will beat that. Warren Buffett didn't even beat it. So what makes you think that you can beat Warren Buffett without taking a different strategy? This beats Warren Buffett and the returns that you would get in dollar terms. If you were to do all of the metals, you could wax some of these guys. And the risk is not there. You will beat them. Return of 28% per annum of the total return if you started investing in 1988 down at this level. Now, I'm cherry picking data. I get it. But that's the possibility with just a swap between these two metals. You don't even need to, you're not even using the whole spectrum. Use the whole spectrum and everything gets blown out of the water. And right now, the most valuable thing to purchase is, I don't know why that's going on is platinum. It's the cheapest against all. Palladium was the cheapest down here against all the metals. Palladium was at about $200, a little under $200 in 09, and went all the way to the peak of in 2020 about $2,800, $3,000. So under 200 to over $3,000. And what you could have done is swap your metal into silver at a 1 to 168 ounce ratio. And right now it's down to 51.37. It keeps dropping. And I think we could get back below 20 again. If that's the case, do you know how much money you would have made in dollar terms? It's ridiculous. It is absolutely ridiculous. Now you're going to say, "Oh, that's from 2009 all the way till 2023." Well, that's what it takes. And it's going to be a ridiculous return, an absolute ridiculous return. Let's just do it for the heck of it. Let's say you bought at the bottom. I'm cherry picking numbers. I know. So I'm cherry picking it. So you put in $10,000. You divide by, let's say it was like 180. So you have 55 ounces there. You swap it here. So you have 55 ounces of palladium. You ride it all the way up from 2009. You swap it at 168. Now I'm cherry picking the data here. Let's just say 160, okay? Multiply it by 160, all right? You have 8,888 ounces of silver. Now it's at 51.37. So if we were to just convert it back, so divide it by 51.37, your ounces of palladium is 173 ounces of palladium. So you had turned $10,000 into, and I think palladium, if I can remember, is about $1,200, if I can remember right. Palladium is $1,240. So you multiply 173 times 1,240, you turned 10 grand into $214,565. And the risk that you took was minimal. There is no risk in terms of inflation, deflation. There's no risk in terms of CEOs not getting permits, not getting taxed because of the jurisdiction, etc., etc. This president, the worries around the president, etc., etc. There's so much crap. This is a huge part that I play with my strategy. It's a big portion of my portfolio. And that's how you do it. You just swap ratios when the market conditions change. But I do think palladium's probably going to come all the way back down to like 800. That's the time to go long. And hopefully in this same time frame, platinum rips it to the upside. Fingers crossed. And then you can swap back into it. This would be a return move to the breakout. And that would be one heck of a buying opportunity in the $800 range. Hopefully at that time, platinum is 5 times the price of palladium. If palladium's at 800 and you get 5 times $800, platinum would be at 4 grand. And that actually works from a ratio perspective and it works from a channel perspective. If you were to chart platinum out on a long-term chart, it priced in logarithmic. Now this isn't a long enough time frame, but you can do a log chart and you can run off the peaks here, and it goes all the way up to about 4,000 would be the top channel. So it all aligns. It all aligns, and that's palladium there. Shots fired. Hearing this week that Warren Irwin has become a very unpopular figure on Wall Street, given many fund managers cut their Camco holdings in February after his bearish claim of an oversupplied uranium market, missing out on 50% plus CCJ gains since then. And I know this was big. Warren came out with a negative piece, and I'm like, I don't really care. We're going higher. We're gonna go higher. These, in my opinion, a lot of the guys don't know the markets. Maybe perhaps to the extent that they should. It's dealing with credit and money rotation, and I don't think they're taking that into consideration. It has nothing to do with the supply demand imbalance. It has everything to do with credit and people selling out of areas that don't work. It doesn't mean that it's going to go straight line higher though. So there's going to be pullbacks in this thing. And that's what's going to mess a lot of people up, are those pullbacks. So it's a tough game to be playing the short term. That's all I'll say. Long term, uranium looks fantastic. Builder comments. 7% plus interest rates, funds to close, and monthly mortgage payments are much higher than many buyers can handle. Market is slowing down, strong interest, financing is the main issue. Spiking rates causing some pause. There's strong interest in home buying. The problem is the affordability, the interest rates. So everything is going at a molasses speed. We're not going to crash, I don't think, but we're going at molasses speed. And that's what we've got for today, guys. That's what I've got. Hopefully you guys enjoyed it. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. I do go over a lot of those things that I went over. Ratio investing. We're looking at ratios. We're seeing what's down. I follow this stuff basically day in and day out, and I know where the value is in the market. I think I know what the best companies are. I've got some big fat dividend paying companies too if you want to play the dividend game. And I'm playing it. Definitely playing it with a good chunk of money. I'm playing the speculative game too. I've got my hands everywhere I can. I think the bull market's coming. It doesn't matter. I don't think a recession can stop it. It can delay it. It can bring it down, but it's delaying the move. It's not stopping the move, guys. A 20% pullback or a 40% pullback does not hurt you if you ride through it. But you got to have the vision. You got to have the strong hands. And then you can add to it. Add to the position. Keep going. Time in the short term, very difficult. I think a lot of people are going to mess it up. Just like Warren did. Warren Irwin. Messed it up. But that's what I've got for today, guys. Hopefully you guys are having a good day. And yeah, we'll catch you next time, guys. This is Finding Value.